Hello and welcome to ThePrint. This is Bidisha and you're watching Economics. Over the past few years, one phrase has become increasingly fashionable in global economic debates: de-dollarization. You hear it at BRICS summits, you hear it in discussions about energy trade, you hear policymakers talking about reducing dependence on the US dollar, sanctions on Russia, the rise of China, and a more fragmented geopolitical landscape. All of this has led many commentators to ask a dramatic question: is the world finally moving away from the US dollar? It's an intriguing debate. But if we step away from geopolitical rhetoric and instead look at how financial markets actually behave during moments of crisis, a very different pattern emerges. Because when genuine uncertainty strikes global markets, the world still runs to the dollar. Not away from it, but to it. And this behavior tells us something fundamental about the architecture of the international financial system. Financial crises are moments when markets reveal their real priorities. During stable times, investors talk about diversification, new financial centers, and emerging alternatives. But when panic hits, priorities change very quickly. In those moments, investors are not looking for political symbolism. They are looking for liquidity. They want assets that can be bought or sold instantly in enormous quantities inside a legal and institutional system they trust. And in today's financial system, no market matches the scale and liquidity of US Treasury securities. Which is why, again and again, crisis ends up strengthening the dollar. Let's start with the most dramatic financial collapse of the modern era: the global financial crisis of 2008. This crisis began in the United States itself. It was triggered by the collapse of American mortgage markets, the failure of major US financial institutions, and a massive loss of confidence in the US banking system. If there was ever a moment when investors might have abandoned the dollar, this should have been it. But the opposite happened. As panic spread across global markets, investors rushed to buy US Treasury securities. Capital flowed into dollar denominated assets even though the crisis had begun in the American financial system. Now, the question is why? Because during a crisis, investors do not simply ask where the problem started. They ask a much more practical question: where can I park enormous amounts of money safely and instantly? And the answer was, and still is, the US Treasury market. Now, fast forward to 2020. The world was hit by a very different kind of crisis: the COVID-19 pandemic. Entire economies shut down, supply chains froze, financial markets entered a sudden and violent panic. And once again, we saw the same pattern. Banks, corporations, and governments around the world suddenly began scrambling for dollar liquidity. In fact, the demand for dollars became so intense that the US Federal Reserve had to open emergency dollar swap lines with central banks across the world. Again, the question: why? Because a huge portion of the global financial system runs on dollar funding. It runs on international trade, corporate borrowing, global bond markets. When stress appears in the system, the demand for dollar liquidity rises sharply. Then came another shock: Russia's invasion of Ukraine in 2022. The conflict triggered enormous volatility in energy markets. Sanctions disrupted financial flows and geopolitical risk surged across Europe and beyond. Once again, the dollar strengthened. Investors increased their holdings of dollar assets and capital flowed towards US government securities. We in economics often describe this behavior as the safe haven effect. During periods of instability, investors gravitate towards assets that combine liquidity, scale, and institutional stability. For decades now, the US dollar has functioned as the world's ultimate safe haven currency. Now take a look at this chart on your screen. It shows the nominal broad US dollar index during three major global crises. Number one, the 2008 financial crisis. Number two, the pandemic shock of 2020. And number three, the Russia-Ukraine war in 2022. Each time global instability surged, the dollar strengthened. Not because investors were making a political statement, but because they were looking for liquidity and safety at scale. And the US Treasury market remains unmatched in that respect. We can see the same pattern unfolding even today. As geopolitical tensions escalate in the Middle East involving Israel, Iran, and the United States, global markets have once again turned towards the dollar. Rising geopolitical risk, volatile energy prices, and heightened uncertainty, all of these factors tend to push investors towards dollar denominated assets. In global finance, uncertainty and dollar demand tend to move in the same direction. There is another important dimension to this debate. Over the past decade, the United States has increasingly used financial sanctions as a foreign policy tool. Countries can be cut off from the global payment systems, central bank reserves can be frozen, banks can lose access to the dollar clearing system. The sweeping sanctions imposed on Russia following the Ukraine invasion demonstrated the extraordinary reach of the US financial system. Critics argue that this weaponization of finance will accelerate the search for alternatives to the dollar. Some countries have increased their gold reserves as well. Others have experimented with local currency trade, and some are exploring alternative payment mechanisms. All of this feeds the narrative that the dollar's dominance might be weakening, but sanctions also reveal something else. They reveal just how deeply embedded the dollar is in global finance. Sanctions work precisely because so much of the international financial system passes through dollar-based institutions and dollar-based infrastructure. Correspondent banking networks, dollar clearing systems, international bond markets, global payment channels. This creates what might be called a sanctions paradox. The more visible power of the dollar system becomes, the clearer it becomes why it is so difficult to operate outside it. Now the question is, can the world actually de-dollarize? Now none of this means the global monetary system will remain unchanged forever. Over very long periods of time, currency systems do evolve. China's economic rise could gradually reshape financial flows, regional financial arrangements may grow in importance, and technological innovations like central bank digital currencies could alter the way cross-border payments are settled. So a more multipolar monetary system is not impossible. But here is the key point. Structural change in global currency system tends to unfold over decades or even generations. And the deeper reason lies in something we in economics call network effects. The dollar dominates global finance in several critical areas. It is widely used for trade invoicing, it dominates in cross-border lending, and it remains the primary currency for international bond markets. According to the IMF data, the dollar still accounts for roughly 58% of global foreign exchange reserves. The euro comes next, but far behind. Other currencies remain relatively small players, and this creates a powerful self-reinforcing dynamic. The more widely a currency is used, the more convenient it becomes for everyone else to use it as well. One useful way to think about the dollar is this. It functions as the operating system of global finance. Thousands of financial institutions, millions of transactions, trillions of dollars in trade and investment, all running through a financial architecture built around dollar markets. Replacing such a system would require not just a rival currency. It would require equally deep financial markets, trusted institutions, and a global ecosystem of banks and payment infrastructure. At present, no alternative offers that combination, which is why discussions about de-dollarization often confuse geopolitical ambition with financial reality. Governments may wish to reduce the dependence on the dollar, but markets continue to rely on it. And when global uncertainty rises, when wars break out, financial markets wobble, or economic shocks ripple across continents, investors do not search for a new financial center. They return to the one that already exists. So the debate about de-dollarization will likely continue. But the behavior of markets during moments of crisis tells a much clearer story. The global financial system may gradually evolve, but when uncertainty rises, when markets panic, when liquidity suddenly becomes the most valuable asset in the world still runs to the dollar. And more often than not, global crises don't weaken the dollar, they strengthen it. Thank you for watching.